I want to share with you 5 tips that you can implement to legally reduce your taxes. Now, I personally utilize each and every one of these tips that I'm going to cover in today's video, and I'm absolutely certain that you'll be able to utilize at least 2 of these tips to lower your federal taxes. The first tip that you can implement to reduce your taxable income is to contribute to your company's 401k. Contributing to your 401k not only allows you to save money and invest money for your future, it also allows you to reduce the amount of taxable income that you have to pay for the year. If you're a single person and you make between $47,151 and $100,525, then you are taxed at a rate of 22%. Now, in the US, we do have a progressive tax system, meaning that any dollars that you make between $1 and $47,150 is taxed at 12%, and then anything above $47,151 to $100,525 is taxed at the 22% tax rate. So, for example, if you are making $55,000 a year as a single filer and you want to reduce your taxable income to move you down to the 12% tax bracket, you would need to contribute $8,000 into your 401k, which would reduce the highest tax percentage that you would pay on your earned income for the year from 22% down to 12%. So not only do you get to contribute to an investment fund to help secure your financial future, you're also able to utilize those contributions as a tax break against your W-2 income. Now, the second tip that you can implement to reduce your taxable income would be to contribute to a health savings account. If you have health insurance through your employer and you have a high deductible plan, you are eligible to contribute to a health savings account. The maximum amount that you can contribute to your HSA is $4,150 for a single person and $8,300 for a family. There are companies out there that incentivize their employees to elect to go with high deductible plans, and they'll compensate you by contributing money to your health savings account. Health savings accounts are great accounts because you can utilize the funds in that account to pay for eligible medical expenses. And on top of that, the money that you contribute to an HSA is done so tax-free, and you are able to withdraw any of the money out of that account tax-free whenever you are paying for eligible medical expenses. Now, 2 things that I really like about a health savings account is that a health savings account is your personal savings account that you can put money into to pay for current or future medical expenses. And the great thing about it is the money that's in that account is yours forever. The funds in that account do not expire, and you can elect to utilize them now, or you can save them to supplement your healthcare costs during your retirement years. And on top of that, there are some companies that will allow you to take the money that you contribute into your health savings account and invest that into the stock market month after month, which will also allow you to increase the money that's in your health savings account. So if you're looking for a place to park additional tax-free money into that will allow you to build an account that can help you supplement your healthcare costs at retirement, then an HSA could be an option for you. Now, the third tip that you can implement to reduce your taxable income is to contribute to a flexible spend account or an FSA. Now, FSAs are great because FSAs allow you to invest tax-free money and then later on withdraw those funds to pay for things such as over-the-counter medications, prescription medications, deductibles, and co-payments. There is also an option to contribute to a dependable care FSA that will allow you to contribute tax-free money for things such as babysitters, nannies, and daycare. Now, FSAs are very similar to HSAs, but there is one distinct difference between the two. The money that you contribute to an FSA have to be utilized in the year that you are contributing the money in. So for example, if you are putting $2,000 into a flex spend account for 2024, you have to utilize those funds for qualified purchases prior to the end of the year, or those funds are gone forever. So if you're going to opt to go with an FSA option, you want to make sure that your expenses are pre-planned out for the year to ensure that you are not losing the money that you are contributing to your fund. And the maximum amount that you can contribute to your FSA is $3,200 for the year. If you're getting some value from this video, consider subscribing, and while you're at it, hit that like button. I would really appreciate it. Now, the fourth tip that you can implement to reduce your taxable income is to start a small business. And one of the small businesses that come to my mind when I think about starting a business is becoming a real estate agent. So you could become a part-time real estate agent, and any of the fees associated with obtaining your real estate license or utilizing your car to do showings for potential clients are all tax deductible. You can also deduct things such as your home office, a portion of your cell phone bill, a portion of your internet bill, or any office supplies such as desks, computers, and printers are all tax deductible if you are utilizing them as a part of your business. Now, you'll want to make sure that you are reviewing and discussing each of the deductions that you plan to take with a qualified tax professional to ensure that the items that you want to deduct are valid deductions. And the fifth tip that you can implement to reduce your taxable income would be donating to charity. Donating to charity is a positive thing that you can do for your community, and it can also allow you to have a tax deduction against your W-2 income. If you are donating cash to the places such as the Red Cross, you'll want to make sure that you're getting a receipt for all of the donations that you make. If you're donating items to places such as Goodwill or the Salvation Army, you'll want to go into their website where they will typically have a list of items that are typically donated along with a fair market value of the items that they typically receive. Now, you'll want to use that as a guideline for any of the donations that you make. It will ultimately be up to you on the value that you place on the items that you donate. Okay, so that's 5 tips that you can implement to reduce your taxable income. Check out the next video if you'd like to see the list of the 8 items that I'm not wasting money on in 2024.